The broader markets are currently projecting an illusion of stability, but the underlying metrics reveal severe structural fragility. This line chart maps the CBOE Volatility Index. The VIX has surged to 23.87, signaling increased market fear. Layered on top is the energy sector. Crude oil violently spiked 11.9%, pushing the price per barrel to $112.06. Yet, if you look only at the top-line indices, you miss this tension completely. The Nasdaq Composite is currently sitting nearly flat, up a fraction of a percent at 0.18. When macro instability rises and broad indices stall, institutional capital rotates. It pulls out of passive index tracking and actively hides in event-driven catalysts, situations where a specific corporate action isolates a stock from the broader market chaos. Generating alpha in this specific environment requires ignoring the broader index entirely and targeting these isolated structural bidding wars. Right now, the prime vehicle absorbing that event-driven capital is the low Earth orbit, or LEO, telecommunications sector. At the center of this rotation is Globalstar, trading under the ticker GSAT. In a single session, the asset surged over 13%, closing at $77.73. That price action is the direct result of a leaked catalyst. Reporting from Reuters and the Financial Times indicates that Amazon is currently exploring a $9 billion acquisition of the company. Amazon is pursuing this buyout to immediately build out a direct operational rival to SpaceX's Starlink network. However, this transaction faces a massive structural hurdle. Globalstar already has a deeply integrated pre-existing infrastructure partnership with Apple. The underlying asset driving this bidding war between tech monopolies is Globalstar's globally harmonized spectrum, specifically band N53. Globalstar is no longer trading on the reality of its daily business operations. It is trading entirely on the strategic scarcity of that spectrum. To evaluate the true risk of this trade, we have to strip away the buyout hype and look directly at the corporate balance sheet. Following the recent price surge, Globalstar's enterprise value is now cresting at $10 billion. This bar chart illustrates the valuation gap, a towering $10 billion enterprise value juxtaposed against total annual revenue of just $273 million. Profitability degrades further, with a negative net income of $19.26 million. This pushes the price-to-sales ratio to an extreme 36.6. By any traditional cash flow multiple, buying the stock at this level is mathematically unsupportable. This extreme mathematical disconnect proves that the broader market has already priced in a near 100% probability of an acquisition. Any capital deployed here is purely a binary bet on the M&A premium actually materializing, rather than a fundamental investment. While retail traders are aggressively bidding up the stock, executive conviction tells a different story. A review of the SEC Form 4 filings on FinViz reveals heavy executive insider stock liquidations. This digital ledger highlights internal selling. CEO Paul Jacobs sold 53,479 shares at $34.95, followed by massive options exercises. Simultaneously, CFO Rebecca Clary unloaded multiple blocks across the $44 to $67 price range. These executive sales occurred just weeks before the Amazon rumor leaked. Does heavy insider selling invalidate the buyout thesis, or is this simply standard liquidity generation for the founders ahead of a complex transaction? While executive liquidation does not guarantee a deal collapse, it mandates strict mechanical downside protection for anyone executing a trade in this environment. Understanding the fundamentals is only half the equation. We now have to establish the execution mechanics. The primary metric governing risk for this specific trade is the average true range, or ATR. Currently, Globalstar's 14-day ATR is sitting at 5.34. Practically, this means the stock swings an average of $5.34 every single day. That is roughly 7% of its total underlying price in a single session. This equation dictates execution rule 1, volatility scaled sizing. To absorb a 7% daily swing without triggering a margin call or emotional panic, a standard block position must be cut exactly in half. Execution Rule 2 requires avoiding the immediate retail bid at the market open. The stock's relative strength index is currently sitting at 68.79, pushing directly into the overbought danger threshold. Buying market orders immediately after a catalyst is amateur behavior. Institutional execution requires waiting for volatility to contract and securing technical pullbacks. The exact strategy to deploy here is the gap fill pullback. Looking at this daily candlestick chart for GSAT, need to find the precise buy zone inside this highlighted green box, between $70.50 and $72.50. The tactical logic here is simple. You allow the morning euphoria to burn off, giving the lagging moving averages time to catch up to the elevated price action. Once filled, the upside target exit is set at $88 to $92. If the rumors are confirmed, Amazon's premium must be priced above that $9 billion threshold to successfully outbid Apple's existing integration. The absolute stop loss is placed rigidly at $64. A daily close below $64 breaks the near-term moving average structure. It technically invalidates the M&A momentum entirely. This specific structure forces a predefined, highly asymmetric risk-to-reward ratio. It protects the trader's capital, regardless of whether the rumor actually materializes. Trading an event-driven catalyst requires intense emotional discipline and a strict adherence to structural stops. Letting media hype override quantitative data is the fastest way to blow up a proprietary trading account. Thesis metrics were sourced from data and insider filings via Google Finance, FinViz, and MarketWatch, alongside catalyst reporting from Reuters and the Financial Times. The framework is clear. Let the underlying data dictate your execution, never the headlines.